Hello, everyone. Chad Frantzen. Welcome to the Kingdom Finance Show. I'm so glad you're here. On today's program, we're going to talk about the earnings season coming up in the stock market. We're recording this at the beginning of the fourth quarter of 2025. So we're going to talk about expectations for the broader stock market in earnings seasons, talk a little bit about AI and some asset positioning as we head into the year end of 2025 and start to look towards what's on the horizon for the economy and the markets in 2026. So thanks so much for being here. Please like and subscribe to the Kingdom Finance Show. Really appreciate that and would love to hear from you. Please forward this show link to your friends, family, and colleagues, anyone who is really looking to align their values with their money. And we really believe it's important to give your money and your resources a voice, to help make the world a better place, to aid in human flourishing, to solve some of the world's greatest problems. And we know we're called to be good stewards of the team members we have around us, of the companies and nonprofit organizations that we help lead and manage. And certainly when it comes to investing, our goal here on Kingdom Finance Show is just to give you a broader picture by aligning values with what's going on in the market, what's going on with the economy, and you can make informed decisions and have clarity about your finances. Well, let's jump in on today's show. Again, we're recording this the first couple of weeks of October 2025. We'll have some more updates on the markets as earnings season is about to kick off here in the United States. And really after about 5 months of steady gains in the broad stock market, as it were. October really enters on pretty solid footing. Now, historically, October can be a pretty volatile month in the stock market. We've had some major bear markets in October in years past, even going back to 2008 and 1987. But overall, things look, although we've got a lot of high valuation, we look at some of the valuation metrics, they are higher. But there's also some reason for optimism of why this market could continue to expand the multiples in that. It would not be uncommon or unexpected, should I say, for us to see some consolidation in some of these risk asset classes. And consolidation, by that, we just mean some pullbacks, some profit taking, or some rotation from one asset class to another. That's normal behavior, and we would say even healthy behavior for the equity markets. Typically, the more we move into the year end, we'll even see more favorable momentum as it goes into the year end on that. And then, of course, all bets are off once you get into January at the beginning of a year. Usually those first couple of weeks will determine a bit of where the cruise ship is headed for the year, but let's not get ahead of ourselves too much. The upcoming earnings seasons will be key in determining if the recent rally we've seen, really 5 months of steady gains in the U.S. equity markets and global markets have even done better than the U.S. because their valuations were a little lower on that. Earnings season will give us a good indicator if this momentum and the recent rally will continue on that. Overall, corporations are guiding pretty positively as far as consumer demand, and there's definitely been pretty strong capital spending on that. Still seeing the effects of tariffs working their way through the economy. That's keeping inflation a little higher, around that 3% mark. So some margin pressure on consumer staple companies and some other companies that their products are being more affected than others because of tariffs. Well, let's talk a little bit about AI. AI has certainly been, I was reading a study, I can't remember which investment bank, of just the percentage of market gains and earnings growth has been contributed to AI. But, AI is definitely still very much, page one news in the markets. What's interesting is this whole innovation revolution and AI, really starting in semiconductors with NVIDIA and Broadcom and others, and then kind of going into software with Oracle and other companies. it's now kind of working its way into the ecosystem a little more of the US and global economy. And what we're seeing is it's really adding to this kind of new um, cycle, if you will, of capital spending. I was reading a study that every dollar, so listen to this, every dollar spent on AI computing capacity. So for every dollar you spend on AI computing capacity, the end result is it will create around $7 or more of incremental investment. So it's almost like a 1-to-7 ratio of it's really a multiplication effect on incremental investment that it's going to create in kind of downstream industries. So, supporting industry. So it's almost this like multiplier effect of what AI is doing at kind of the software computing level. It's really working its way into all the different sectors of the economy. That's a positive trend. That it's also one reason why when we look at certain indicators like P ratios and the Buffett indicator, the Buffett indicator is at an all-time high. That is really looking at kind of the price to sales ratio of things. Berkshire Hathaway does have an all-time level of cash that they have on hand. Historically, have been very good in Omaha about having cash and looking for really good buying opportunities on that. So never a bad idea to have cash, have some dry powder, because when we see consolidation, rotation, some opportunities, you want to have some resources available that are not tied up, that you don't have to sell and take a tax impact on to go put in some assets that you really want to own. The Buffett philosophy is, hey, if we can understand the business, we would like to own companies for decades, that we would take an extra long-term approach to owning companies that we understand their business model, we understand how their earnings work, and we want to earn great companies forever, right? Now there's a time and place to do rebalancing, but oftentimes as investors, we get so caught up in the short term about what's happening in Washington, what's happening on social media, what your friend at church or your neighbor told you they were investing in. We lose sight of kind of the long-term wisdom of buying quality and owning it for the long term. It's not uncommon in behavioral finance for investors, for retail investors, to not get near the rate of return that institutions, hedge funds, asset managers get, because they are a little more non-emotional about it. They're a little more cerebral and disciplined on their buying and selling decisions. The old adage is, buy low, sell high. It's easier said than done because the psychology of the retail investor who doesn't follow the markets day to day, hour by hour, like a lot of Wall Street and hedge funds do. They don't know what they don't know about what's happening in the markets and where big money, what I call big money, the big institutions, where they're going in, because that's where you want to be. If big institutions are going into certain asset classes, they know a lot more than you and I as the retail investors. So it's wise to kind of follow the big whale into particular asset classes that may have, regulatory favor. They may have momentum with where the economy is on that. So encourage investors. You want to really keep that long-term perspective. We want to be mindful of what's happening with the government shutdown, with earnings, with interest rates, what's happening globally and in the U.S. But we also don't want to let short-term volatility, if an individual company is down or a particular ETF is down, we don't want to say, hey, oh my goodness, I'm seeing this particular investment, it's down 7%. I've got to get out of it. If that's the psychology an investor has, then they really need to reevaluate their risk tolerance, right? Or as we used to teach, the speed limit, the speed at which you're driving, right? If you really need to be in a school zone versus in a 55 versus on an open interstate 75, you're probably not driving that one speed all the time. Same way with investment portfolio theory is you want to be driving different speeds with your resources as you're investing them. So if you're investing for growth and you're in things like small cap or AI or cryptocurrencies, you need to understand that's being in the left lane on a big interstate, and those can have some volatility, but they're also good assets to be accumulating or averaging into when there is consolidation or pullbacks in those assets. So again, happy to talk more about what that means for you, your organization, your personal finances. But I wanted to just kind of bring that up as we're talking about what's happening in the markets on that. So again, overall, we think it would not be unexpected to see some consolidation and some market volatility here in October, November. I think as we move through earnings season, we'll get a pretty good idea on how corporations are doing with the impact of tariffs, their capital spending, and an overall outlook for Q1. But I am short-term bullish on what's going on with the U.S. economy and the markets. And I do think AI's impact on capital spending, it does help give some perspective on, well, these valuations are high, what should we be doing? Again, always a good idea to have a well-diversified investment strategy. The wisest man in the world, Solomon, from the days, Old Testament days, he said you should invest in, 7 or 8 different things because you do not know what will come up on the land. And that's certainly true today. We have all sorts of things going on with wars and rumors of wars and geopolitical tension and government shutdowns and interest rate policies and innovation. And innovation is a very positive thing, but it's really good to have a well-oiled, diversified machine with your investment portfolio. Again, some of the names we're seeing asset class wise, I'll just kind of run down, a handful of these. Hard assets continue to be very bullish. Now, again, I'm gonna run down a few of these. I'm not here to give you specific financial investment advice. Again, this is an educational show. I'm just sharing with you some of my opinions on that. So I encourage you to visit with your financial advisor. Consider your own risk tolerance, suitability for your strategy. And if you're looking, I'll give a shameless plug here on the show. If you're looking to connect with a faith-driven financial advisor, we've got a great team at Wealth Builders Investments that we've got some certified financial planners and licensed financial advisors. We'd love to connect with you and just give you a complimentary consult on, hey, what's my strategy look like for my personal finances, maybe planning for retirement, college, or even you're helping lead an organization. It could be a for-profit or a not-for-profit organization. You've got finance meetings. You're working with the CFO or with the 401k plan, 403b administrator. We'd love to come alongside you and give you some counsel on that. Best way to connect with our team, go to wealthbuilders.net/invest. That's wealthbuilders.net/invest. We've got a free download for you there, free resource guide, and then you'll be able to get access to our calendar. We put out a kind of a limited number of appointments each week. And then when those fill up, they're gone. But we put those out there just for people who come in through the different conferences we attend or through the show as a way to talk more at a one-on-one personal level. It's hard for me not knowing who watches the show, what your investment needs and questions are. Well, let's run through some of these just here for a few minutes, and then we'll wrap up the show on that. Certainly hard assets, very bullish still. Gold has reached an all-time high, $3,900, $4,000 an ounce for the first time. We still love that. We do have that in our model allocations at Wealth Builders Investments. There's some other hard assets, although gold is always the number one. But silver has started to have a resurgence. It has underperformed gold, but usually, again, that means, hey, that might be a good time to be buying it. If it's still a hard asset we like and it's underperforming, we might want to be looking at adding a dosage to that. So gold and silver still very strong. There's some other hard metals out there, platinum and palladium. Both are bullish commodities, hard assets. We don't generally see investors or institutions overweight those. It's generally a basket of hard assets, if you will, and primarily in gold with then some silver and maybe a little bit of platinum and palladium on that. Those are more volatile, but those have been very bullish, and a lot of institutional investors like that. Certainly cryptocurrency, Bitcoin hit an all-time high here recently at 125. The crypto space looks good. Again, that's we would view that as a basket. So if you're going to have an allocation or a dosage to that, that's a basket you would consider. Maybe a handful of cryptocurrencies. Again, we buy those through our portfolios at Wealth Builders. You can also buy those directly on different exchanges. The primary cryptos are the ones, if you've heard of them, I think everyone's heard of Bitcoin, but Bitcoin, Ethereum, Ripple, and Solana. Those are probably your top four on that. So not uncommon for an institution or an individual. Again, you can trade in and out of those. They have enough volatility, but what we're talking about is, hey, do we have a well-diversified portfolio, different baskets of assets that we like? We might weight them a little differently. That would be how I would approach personally, approach hard assets like gold and silver, as well as digital currencies on that. Consumer staples, that would be more of a bearish sector right now. And even home building, we'd probably be a little bearish on that. Just there's still a lot of interest rate sensitivity to the home builders and consumer staples companies. Those are kind of your everyday consumer goods. A lot of inflation and tariff impacts still working through those. So overall, technically speaking, those would be a little more bearish on that. Let's walk through a few more as we wrap up here. Overall, NASDAQ, technology stocks, momentum, AI, those are very bearish. Again, now when the economy shifts, when the market shifts, and that can happen, in a day's notice, it doesn't just happen, over time. It can happen overnight. Those higher valuation companies will see the most contraction, historically speaking, in their stock price. I would say, most of the technology stocks are pretty bullish outside of Netflix, which has had a lot of issues because of their policies on their content and programming. And there's even a lot out with Elon Musk recommending people get out of that because of some unwise, unhealthy choices in their content creation for kids, which has provided a lot of pushback from faith and family folks like myself and many of you in the U.S. So, Netflix would be very bearish. We don't currently invest in that anyway, just because of some material differences we have in their programming and content on that. So technology remains bullish. You look at even some of the Mag 7 still look favorable. There's a lot of momentum piling into that. If you look at momentum ETFs, you're going to see a lot of the big names: NVIDIA, Broadcom, Microsoft, Facebook, Google. Still a lot of favor with the institutions to be in those positions. Again, I mention these names just to give you an idea of what they're doing. I'm not telling you specifically to invest or not invest in them, but institutions definitely find themselves pretty heavily invested in a lot of those positions right now. Speaking of gold, even the gold companies, there's different stocks and ETFs that are the actual corporations that go and mine gold and procure it. Those are very favorable, as you might expect, with gold and silver being at the prices that they are at. Well, that gives a quick rundown on that. Happy to take question and answer from folks. I just encourage you to reach out to us at wealthbuilders.net/invest if you have specific questions on investing. Again, this show's not designed to give you specific advice. We're just kind of sharing market commentary, economic outlook, giving you some insight at some different asset classes that we look at. So that'll wrap it up for this week's show. Again, I wanted just to dive in a little bit to the market, what asset classes are doing, and we'll continue to report back with how asset classes there could be some rotation, some consolidation as we go through the end of 2025 and the implications of the government shutdown and implications of what we expect to be 2 more interest rate cuts, one coming up at the end of October and another one in mid-December, right before the Christmas and New Year's holiday on that. So with that, again, we encourage you, we're here to help you gain clarity with your finances and your investment strategy. We encourage you to align your faith with your finances and allow your money to have a voice to help make the world a better place and to create an impact that is one that supports your values. So with that, I'll sign off. Please like and subscribe to the show today. And if we can help you in any way, again, please connect with us online, wealthbuilders.net/invest. We've got a great free resource for you on there. And our team is standing by just to connect with you personally to help give you guidance on, great, Chad, I've heard some of these episodes. What do I do now? How do I evaluate my own financial plan, my own investment strategy? What should I be doing between now and the end of the year to manage my resources in a wise fashion? So thanks so much for being a part of the Kingdom Finance Show, and we'll see you next time.
Thank you so much for joining me today on the Kingdom Finance Show. If you enjoyed this podcast, please subscribe and leave us a review. It really helps to get the word out. For more resources on becoming a Kingdom investor and to connect with us directly, visit our website at wealthbuilders.net. That's wealthbuilders.net. We'll see you next time on the Kingdom Finance Show. The content provided is for educational purposes only. We encourage you to seek personalized investment advice from your financial professional. For all tax and legal advice, please consult your CPA or attorney. Investment advisory services are offered through Authentic Counsel, a registered investment advisor. Securities are offered through Cabin Securities, a registered broker-dealer. The content of this podcast does not constitute an offer of securities. Offerings can only be made through an offering memorandum, and you should carefully examine risk factors and other information contained in the memorandum.